Howdy, folks. Welcome to Liberty Call. Today is Wednesday, April 10th, 2024. I hope you are having a fantastical day out there. You see my boy Jake back here is tired. He's had a little bit of an upset tummy, and so he's taking it easy today. We are, though, going to go out and play in a little bit after I finish this video. So, anyways, the markets today, did not like the CPI data that came out. And could we call it a bloodbath? My name's not Donald, so it shouldn't get me in trouble. So anyways, all right. Well, before I dive into the numbers for today, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follow, and press that notification bell. All right, let's get into the numbers for today. Let's get this off the screen. Dow Jones was down 1.09%, 422 points, closed at 38,461. S&P 500 down 0.95%, closed at 5160. The NASDAQ down 0.84%, closed at 16,170. The VIX was up 5.47% today. It's at 1580 right now. Canada down 0.73. Brazil down 1.41%, and Mexico down 1.51%. So it looks like we were a bit of a contagion for them too. Let's head over to Europe. Germany was up 0.11%. The UK up 0.33%. France down 0.05%. The Netherlands up 0.64%, Spain down 0.38%, Italy up 0.27%, Switzerland down 0.09%, and Portugal up 0.06%. Russian exchanges both green today. The MOEX up 0.68%, the RTSI up 0.02%. And the Asian markets look like they were all open. The Nikkei in Japan was down 0.49%, Australia up 0.31%, New Zealand up 0.35%. China's markets, the Shanghai was down 0.7%. Let's see here. Shenzhen Component down 1.6%. China A50 down 0.42%. DJ Shanghai down 0.81%. The Hang Seng up 1.85%. And same with, or actually the Taiwan weighted was closed today. So, excuse me. All right. So that is everything there. Let's go ahead and move over to the market recap. Wall Street slides as inflation stalls, rate cut hopes wane. U.S. stocks experienced a tumble on Wednesday due to higher than expected inflation data, which shattered hopes of the Federal Reserve entering a monetary policy easing phase soon. All three major U.S. indexes fell sharply as the Labor Department's Consumer Price Index report, which landed north of consensus and reminded investors that inflation's journey back to the Fed's 2% target will continue to be a long and meandering one. Minutes from the Fed's March policy meeting reflected officials' concerns that inflation's progress towards the target might have stalled, and restrictive policy may need to be maintained for longer than anticipated. I think they're also going to have to start raising rates too, personally. Equity prices were further pressured by benchmark Treasury yields, which breached 4.5% to touch its highest level since November. Interest rate sensitive stocks were hit the hardest, with real estate set for its biggest one-day percentage drop since June of 22. Housing stocks were on the course for their biggest daily decline since January 23rd, and the Russell 2000 was set for its deepest one-day slide since February 13th. The CPI report prompted markets to reset expectations regarding the timing and extent of Fed rate cuts, which I don't know if there will be any. Financial markets now priced in a dwindling 19.3% likelihood of a 25 basis point rate cut in June, down from 56 just prior to the report's release. Of the 11 major sectors of the S&P 500, all but energy were red, with real estate shares suffering the steepest decline. Mega cap growth stocks slipped with the exception of NVIDIA, which bucked the trend, rising 1.7%. Alibaba shares advanced 1.8% after co-founder Jack Ma released a memo to employees on expressing support for the internet's giant restructuring efforts. All right, so something's good, something's bad. For those who were hoping for rate cuts and cheaper credit, probably not happening anytime soon. Sorry, guys. All right, let's dive a little deeper into the Fed information. Biden promises a rate cut by end of year as Fed minutes signal caution, but QT, which is quantitative tightening, taper fairly soon. The market and monetary policy landscape may have undergone significant changes since the last FOMC meeting on March 20th. Gold remains the strongest performer, while bonds have experienced steepest declines and stocks have remained flat. The dollar And oil prices have seen increases in value. Rate cut expectations have drastically dropped in the last 3 weeks following the Fed meeting. Initially, the market had priced in 3 rate cuts, but now only one is expected, with a 50% chance of a second cut. June has been completely ruled out for a rate cut, and there are even suggestions of a rate hike next month in May. The market's stance on rate cuts is now more hawkish than the Fed's projections from just 3 weeks ago. Given the recent changes, it's important to understand the key takeaways from the Fed minutes. Here are the highlights. And actually, tomorrow I will do an in-depth review of the Fed minutes, even though, like this article points out, things have changed a lot since then. So I will do an in-depth section by section of the minutes. Sorry, it's just so beautiful outside. It's sunny, it's clear. There were deer out here earlier. I was in the middle of a meeting. Sorry to just get off on a tangent here. I was in the middle of a meeting and look up. There's a deer standing right outside my window looking at me. So kept my composure, didn't go, oh my God, So anyways, all right. So here are some of the highlights. For inflation goals, participants noted that the achievements of the committee's employment and inflation goals were moving into better balance. However, recent progress in consumer price inflation has been uneven. Some participants pointed out that recent increases in inflation should not be diminished as statistical aberrations. There's a moth flying around in here. Inevitability of cuts. Participants discussed the likelihood of the policy rate and has reached its peak for this tightening cycle. Well, they may not be true. Almost all participants agreed that it would be appropriate to move to a less restrictive stance at some point this year if the economy developed as expected. They also noted that disinflation process was continuing unevenly, but we haven't had any deflation. Just disinflation is a slowing down of the amount of inflation. So we haven't had any deflation. The economic outlook, some participants expressed concerns about geopolitical risks causing severe supply bottlenecks. There are also concerns that financial conditions might not be as restrictive as desired, which could put upward pressure on inflation. Most participants noted that labor supply had increased due to higher labor force participation and immigration. Yeah, because I guess every American has a job since we have to bring millions of people in across the border. Tapering of QT. It was broadly agreed that a cautious approach should be taken to further runoff given market turmoil in 2019. The majority of participants predict tapering. The majority of participants predict tapering would start somewhere around mid-year. President Biden expressed his prediction that a rate cut would happen before this year's end. He also mentioned that today's CPI report might delay a rate cut by at least a month or two. Fed independence and its focus on achieving maximum employment and stable prices were emphasized. The Fed's decision-making process is not influenced by short-term political matters. Yeah, right. As they have been granted a significant degree of independence by Congress. However, some experts argue that the closer the FOMC acts to the election, the more likely the public will question the Fed's intentions and potentially harm its public standing. Yeah, I don't know how it could get worse. Overall, the market and rate expectations have shifted since the last meeting, and it's important to consider the Fed's objectives and potential impacts of the economy. Yeah, so is what it is what it is. All righty, well, let's get a little deeper into the same subject, hot, and then there were none, possibly no rate cuts this year. The market is repricing the potential number of and timing of rate cuts, with less than 2 cuts being priced in this year. There's a 50% chance the first cut will be in July or earlier, leaving us with a 50% chance in September. This could lead to social media chaos and potential political unrest for incumbents if the Fed does the first cut in September. Incumbents have been hoping to see inflation recede, as high inflation has hurt public opinion of elected officials. Yeah, because it's just the inflation, and they want it manageable coming into the election. The spend it and they will vote mentality in DC doesn't help with inflation. Geopolitical risks abound, and with the strategic petroleum reserve still near multi-decade lows, it's actually about half full. So before people panic too much, it was up here, it's now here. It has a ways to go before it's completely empty. Decade lows, and there are fewer tools to combat it. Incumbents would like rate cuts to produce lower yields and higher stocks, but they are desperate to avoid a rebound in inflation. Rethinking recent Fed speeches, one possibility is that the neutral rate may be higher than previously thought. Markets generally accept that we are at peak Fed funds, and that once the cuts start, we would head towards a neutral rate reasonably quickly. However, what has not been discussed as much as if the neutral rate and terminal rate are higher than expected, meaning higher than where we're at today. So, as I've been saying, I would not have ceased the rate cuts when they did, or held things where they are for the last 6 to 9 months. As the realization sinks in, equities will struggle, and the corollary of American exceptionalism might be higher for much longer. Yep. So not good at all. So was there any charts here? Nope, there was no charts on this one I wanted to show. All right, last up, pump prices continue to surge. Gasoline inventories see a small build. Let's dive into this last article here. Crude prices fell back to their pre-adjusted levels after a hotter than expected CPI print took demand seducing rate cuts off the table. However, oil is still up 19% this year as OPEC Plus cuts supply and geopolitical tensions across the Mideast create strong tailwinds. The market is bracing for Iran's response to a suspected Israeli attack on its consulate in Syria last week, and top traders have been striking an increasingly bullish tone in recent days. API reported a sizable crude build and another gasoline draw, with all eyes on the official data for confirmation. Total crude and product stockpiles climbed by 12 million barrels, excluding SPR last week, with the biggest weekly gain since July of last year. In addition to the crude build, there were also increases in other oils, gasoline, jet fuel, and diesel. U.S. gasoline stockpiles have plunged to the lowest levels this year. They were though they remain above the same period last year. Crude production was flat at 131 million barrels per day, according to record highs. Near record highs. WTI was hovering around 85 and a quarter, ahead of the official data, dipped on data, then rallied higher. Pump prices continue to rise, and tracking wholesale gasoline prices higher. And there's actually a chart here that shows the gas. Gosh, it's ways down. Oh, here it is. All right, so these two, let me make it bigger for you. So you can see here, this is the blue line is the price of wholesale gasoline. You can see it's up near around 370 right now, and in December it was right around $3. So that is a pretty significant jump in this first quarter of the year. Not as high as it was that mid third quarter last year, but we're getting pretty close. So it was around between 380 and 390, and so not good at all if you want to save some money at the pump. So, all right, well that is I think those are all the articles I was going to cover for today. So if you thought that the CPI numbers were not great, and this is certainly not going to help the prices of energy and everything else if the cost of oil is continuing to be on the slow incline. So that's not ideal. I think that's going to give us a second little bump in inflation, which we're starting to see right now. How long that lasts, don't know. I mean, what's the Fed going to do? I mean, they're kind of, like I said, painted into a corner where they have to, if they're going to lower rates, they have to say that things are, there's a reason why, and higher inflation is not a good reason to do it. So they're in a real tough pickle right now. So, all right. Well, like I said, that is everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. I hope you have a wonderful evening. My boy Jake down here is ready to go out and play. And we'll talk to you tomorrow. Adios.